In the previous lesson, we looked at trends and how trends form, and you can now identify and spot them using price action. Trends are the sexy stuff. That's what everyone wants because that's what they think is the big move. That's where you get the 100% moves. That's where you get the big risk reward. That's where you get the huge wins. But if you don't understand ranges and if you don't know how to trade ranges, it'll be very difficult for you to be a profitable trader on short time frames because ranges account for 70 to 80% of all price action. So you have to internalize that and understand most of the time, price does not trend. Let's take an example of last year, 2022, Bitcoin. I'm sure everyone felt like Bitcoin just did nothing but go down last year. But if you actually analyze it through the lens of a price action trader, you'll see that, and this is extending a little bit into 2021 to understand the full bear market, we had a total of 70% of the year in range. 16 weeks, 2 weeks down, 3 weeks down, 10 weeks down, and 1 week. Most of the time, it was going sideways. Most of the time, it was going nowhere. Most of the time, you had ranging action. And so, if you want to miss all of these great trading opportunities in these areas, then by all means, but you're probably going to have to consign yourself to being a trend trader over higher timeframes. There's nothing wrong with that. That might be right for some. But to make money to be profitable and make money over time and compound your portfolio as a professional trader, you need to understand the mean reversion aspect, which is range trading. Important to note now, the range differs from the trend in that the path of least resistance is fixed. So meaning, back to our schematic, in the uptrend and downtrend, the path of least resistance moves with the trend. In a range, it's fixed. The path of least resistance is always changing from top to bottom. It meets resistance at the same place. Therefore, when it gets up to the high, the path of least resistance is no longer to the upside, it's to the downside. But when it gets to the low, instead of breaking out, down, or at the high, breaking up, it finds support and it moves again. Path of least resistance is fixed and direction is always changing. It looks like a flat channel, you see here, very simple, flat, sideways, horizontal. And characteristic of it is that there are a lot of fake outs. A fake out is something like this, where price attempts to break and looks like it's going to trend, then reverses back. Attempts to break, looks like it wants to trend, reverses back. Something like this here is where a lot of people get caught out because it pumps up, it pulls back shallow, it pumps again, and people think it's a trend, when in reality, it's within a range, they get trapped, goes all the way back down, and starts it over again. And then on the downside, it drops, shallow bounce, drops again. People again think, oh, it's a trend, we're going lower, they get trapped. And that leads to what they call whipsaw price action, chop, and it's just really consolidation. That's all it is. It's just consolidation. So why does price do this? Why does it range? Well, you have to understand the law of supply and demand. The price of something in any market, the price of an asset or a good or a commodity, whatever you're buying, it's relatively fixed. It doesn't fluctuate massively on a day-to-day basis. There needs to be some fundamental reason why price would move to a totally new level. So sideways trends, ranges, it's just a zone where previous movement stops, the trend has stopped, and there's a balance between supply and demand. And this is where accumulation or distribution begins. Once it goes into that range, you go into accumulation or distribution in preparation for the next leg of the trend, the new trend, the reversal, whatever it may be. Trading inside ranges offers way, way, way better risk reward and better trading opportunities if you know how to do it. The reason for that is because trend trading, by the time you get onto the trend, you've already missed quite a part of it. Before you know it's a trend, most of the trend has already happened. Whereas in ranging environments, you can catch the top of the range down to the bottom of the range and have clear areas to get in and out. And so because this balance of supply and demand, and because price needs to build energy for the next leg of the trend, if you think of it that way, like I said in the previous lesson, price has to compress and it has to gather its energy before it explodes in another trend. Then you know that you can buy low and sell high within that range until some new information or new developments occur that cause the price to either move up or down into a new trend. And so to be positioned correctly in the range, you need to understand and be able to analyze the action of price as the range develops. One of the best methods for that, the most simple to understand and easiest to teach, is the Wyckoff method. It stood the test of time and it's a classic. Very, very good, very reliable, and it's broken down into very actionable, rational principles. So from here, we're going to jump in and we're going to discuss the Wyckoff method for accumulation, distribution, and we're going to look at we're going to revisit the market phases that I talked about in the previous lesson, And we're going to expand upon that to show how you can actually map them out and begin to trade them.